Okay, so have you ever been like about to enter a trade and you've done all your research and everything looks good on paper, but there's that little voice in the back of your head, you know, the one I'm talking about. It's like, but what if this goes horribly wrong? Like right before you hit enter and you could lose all your money.
Oh, yeah, we've all been there. That's the worst feeling.
Right, it's the worst. So today we're diving deep into a technique that can hopefully quiet that little voice a bit. We're talking about scaling in and out of trades. Now, a listener sent us a really awesome article about this, and it's got all the ins and outs of scaling. So we're going to break it down. Get your notepad ready.
Yeah, this is a topic I'm really passionate about. I've seen firsthand how important it is to manage your risk in trading. And honestly, scaling, when you do it right, it can be a game changer, no matter how experienced you are.
Totally. So the article jumps right into scaling in. Have you heard of this?
Oh, yeah, for sure.
They use this analogy of dipping your toes into a pool instead of just cannonballing straight in.
Yeah.
I kind of like that visual. What do you think?
Yeah, it gets the point across.
But what does it actually mean when we're talking about, trading?
So basically, it means gradually getting into a position instead of just going all in at once.
Okay, I think I get that.
Like, let's say you want to jump into a trade. Instead of buying, say, $10 worth right away, you might start with $2, and then as the trade moves in your favor, you buy more. The whole point isn't to be perfectly timed and catch the absolute bottom of the market, get every single dollar. It's more about managing how much you could lose if it goes the other way.
Yeah, that makes a lot of sense. It's like testing the waters before you go all in. So you're not putting all your hopes and all your money on a single entry point. Instead, you're spreading it out, which reduces your chances of getting burned by a sudden market swing.
Exactly.
But how do you know when to buy more? The article mentioned a three-step process. I think they used a FTSE 100 trade as an example.
Yeah, that's a good one.
Something like that.
Yeah, so the first step is honestly the most important: planning. Before even thinking about entering a trade, you need to know your entry points, where you'll buy in. And these points could be based on all sorts of things. Technical levels like support and resistance zones, or even just news or announcements about the asset. It all comes down to having a plan and sticking to it. Don't just add to a winning trade because it feels good in the moment.
No emotional trading.
Exactly. No emotional trading. You need to be strategic about it. It's super easy to get caught up in the excitement of, oh, this trade is going my way. And then you totally forget about protecting yourself if things go south.
Oh, I've totally been there. You get on a roll, think you're invincible, and then bam, the market does a 180 and you're left wondering what hit you. So tell me, how does changing your stop loss actually work with scaling in? Like, walk me through it.
Okay, so let's use that FTSE 100 example. Let's say you enter a trade at 7,500 and you put your stop loss at 7,450.
Okay, got it.
Now, let's say you add to your position at 7,520, right? You could then move your stop loss up to, say, 7,480.
Okay.
That way you're locking in at least some of your initial profit and you're reducing the total amount you could lose.
So as the price goes up, you're moving your stop loss up too, almost like it's trailing behind the price.
Exactly, you got it. And that's what's so great about scaling. And you're managing your risk way better, but you don't miss out if the trade keeps going your way. But it's not even just about avoiding those losses. It can actually help you make more money.
Right, that's what I like to hear. The article mentioned something about higher profits. How's that work? Is it as simple as you're just buying more as the trade goes up?
Well, it's a bit more nuanced than that.
Yeah.
You're basically averaging into the position. So say the price dips a little after you first buy in, now you can get more at a lower price, right?
Yeah.
So that brings your average entry point down, which means potentially bigger profits if it rebounds and goes back up.
It's like you're getting a discount. Yeah. I like it. But let's be real. No strategy is perfect.
Yeah.
What did the article say about the downsides of scaling in?
Well, like you said, it's not some magic formula. It doesn't work every time for every trader. The article even said that it might not work for every trading style. Like if you're someone who makes a ton of really quick trades, just in and out all day long, what we call scalping, this might not be the best fit.
Right, makes sense.
It usually works better in markets that are trending, moving consistently in one direction, because that gives you those opportunities to keep adding to your position.
So it's not just blindly following the same steps every time. You have to actually know what's happening in the market and adjust. The article also talked about discipline. Like you need a lot of it to be good at scaling in.
Oh, absolutely. It's really easy to get carried away and think, oh, this is going up, let me just keep piling on more money, especially when you see those profits starting to roll in.
You got to have some rules, right? Otherwise, it's just gambling.
Exactly. It's about making smart decisions, not emotional ones.
Okay, so we've covered scaling in pretty well. But the article doesn't stop there. It also talks about scaling out, is that just the opposite? Or is there something else to it?
Well, they're definitely related, yeah. But scaling out, that's all about locking in those gains as you go, instead of waiting till the very end to close your whole position.
Oh, okay. So taking some profits off the table.
Exactly. Imagine this. You're in a trade, things are looking good, and then boom, you see those profits starting to pile up. So tempting to just let it ride, right?
Oh, yeah, definitely.
But with scaling out, you lock in some of those gains as the trade moves in your favor, instead of waiting until the very, very end and potentially seeing it all disappear.
Oh, that makes sense. But wouldn't that also maybe limit how much you could make if the trade just keeps going up and up?
That's the trade-off for sure. It's a balancing act. The article actually gives a really good example with Apple CFDs.
Okay.
So let's say you bought Apple at, we'll say, $150, and now it's trading at $160. You could sell a portion, maybe 25%, and lock in the profit on that part.
I see.
So now you've reduced your risk, but you still have the other 75% to potentially keep growing if the price keeps going up.
So you're kind of playing both sides.
Kind of, yeah. It's like a more balanced approach. And you know what else is great about it?
What's that?
It can really help with your mindset, with the emotional ups and downs of trading. Because it's so easy to get greedy, right?
Now tell me about it.
You see a trade going well and you think, just a little bit higher, just a little bit higher. And then before you know it, it's turned against you and you've lost all those gains you could have had.
Ugh, the worst.
Scaling out takes some of that pressure off. You get to actually enjoy the profits you've already made, and it helps avoid that trap of trying to perfectly time the market top.
It's like that saying, you never go broke taking profits. But the article also mentioned something called running profits. What is that exactly? It sounds kind of similar.
Yeah, so running profits, it's a way to, squeeze even more out of a winning trade by letting part of it keep going, but still protecting yourself if things turn around. Like, imagine you're back in that Apple trade, you've hit your initial profit target, but the market is still going strong.
Okay, good.
Instead of just closing the entire position, you could scale out a little, maybe sell another 25% like before, and then you set what we call a trailing stop loss on whatever's left.
Okay, so you're basically telling the market, I'm happy with what I have, but if you want to keep going, go for it.
Exactly. You're letting your winners run. And that trailing stop loss, that's your safety net. If the market decides to turn around and hits your stop loss, you've still locked in a big chunk of those extra gains.
It's like a win-win. You get to manage your risk, but you also give your trades that extra space to potentially grow even more.
Exactly.
Wow, this has been eye-opening. So whether you're scaling in or scaling out, it seems like the key takeaways are, have a plan, know what's happening in the market, and don't let your emotions take over.
Couldn't have said it better myself. And remember, these techniques, they're not one size fits all, What works for one person might not work for someone else. It all depends on your own personal trading style, how much risk you're comfortable with, all of that.
So do your research.
Yes. And find what works best for you.
That's all the time we have for today's deep dive on scaling in and out of trades. Huge thanks to our expert for breaking down this essential trading technique.
It was my pleasure. Thanks for having me.
And thank you for listening. Until next time, happy trading, everyone.